Good morning, everyone. Welcome to the Foreign Correspondents Club of Japan and to the latest in our series of deep dive presentations. I apologise for the late start. One of our panellists who's joining us from London has seemingly got lost, but we're hoping he will turn up. Anyway, let me... I'm Anthony Rowley. I'm a former president of the club, and it's my pleasure to act as moderator today and to introduce our panellists, and I'll do so in the order in which they will be speaking. Joining us from Washington, D.C. is Hung Tran, who is non-resident senior fellow at the Atlantic Council's Geoeconomics Center, and he's a former executive managing director at the Institute of International Finance. And joining me on my right here is Jesper Koll, a well-known face, who is one of Japan's leading strategists and economists. He's formerly chief strategist and head of research for US investment banks, JP Morgan and Merrill Lynch. We're still waiting for John Greenwood, who is former chief economist at Invesco and chief economist at International Monetary Monitor. So we're going to change the order of speaking slightly, and Hung Tran will be the first speaker. You have seen from the notice of today's event that we're going to be looking at, among other things, the possibility that we could see another Black Monday event in stock markets of the kind that occurred in 1987 and earlier than that in 1929. This might sound a little odd, perhaps at a time when markets appear to be celebrating the slowdown of inflation, but this would not be the first time that markets have indulged in what then US Federal Reserve Chairman Alan Greenspan referred to in 1996 as irrational exuberance in markets. But I won't say any more. Let me hand over, as I said, to Hung Tran. So, Hung, if you could make your presentation first, please.
And thank you for inviting me. It is my pleasure to appear again and speak to the Foreign Correspondent Club of Japan. My remarks probably will be serving as a good introduction and setting the background for John Greenwood, who would focus more on the risk of another Black Monday market crash going forward, because I will highlight the general picture, bringing you up to date in terms of the increased financialization in the economic activities around the world. That is a well-known phenomenon. It has been happening for many years. Basically, financialization is defined broadly to embrace all kinds of financial transactions by all kinds of financial institutions, and the growth of those activities and so on economic activities and even social conditions as well. Accompany the growth in the volume of financial transaction is a growth in the value of financial assets, and the other side of it is debt around the world. Basically, since the 1980s, under the influence of thinkers like Milton Friedman, who argues for laissez-faire capitalism and minimal role of government, and Eugene Farmer, among others, arguing for maximizing shareholder values, we have seen waves of financial deregulation in the US under Ronald Reagan, in the UK under Margaret Thatcher. Financial innovation flourished with all kinds of financial instruments, derivatives, in particular, credit default swaps and so on, allowing and encouraging active trading and hedging by market participants. So if you look at the financial sphere and the real economy since the 1980s, you really see a very worrisome divergence would become very stark at this point. On the one hand, you see the volume of financial transactions, financial wealth rising, increasing very significantly over time. And right now, if you look at the volume of transaction in foreign exchange markets, it amounts to 7.5 trillion US dollar per day, which in my view is really far exceeding any notions of the foreign exchange activity needed to facilitate transaction in trade, in goods and services, and portfolio investment and foreign direct investment. If you look at the volume of equity turnover, for example, in the US, it amounts to 85 trillion US dollar a year, which is 7 times the US GDP. 60 to 75% of those turnover have been executed via algorithmic and high frequency trading operations, basically buying and selling securities in matters of seconds or less. And again, my argument is that it is not clear how this kind of financial transaction and activity could have helped companies raise funds for their businesses and operation. Accompanying that, you see financial wealth increasing also big time. If you look at the Credit Suisse, now UBS, Global Wealth Monitor, right now we have more than $450 trillion in wealth, again, many times greater than the global GDP. And the other side of the coin is, of course, debt, also rising to record level, more than $350 trillion as well. The problem is that the wealth is distributed very unevenly, focusing on the top 1% of population. The debt, however, is distributed more broadly, and many poorer and weaker members of society are heavily indebted. More importantly is the fact that the US and US dollar play a very important role in the whole phenomenon of financialization. Within the US, the financial sector, including banking, securities company, insurance, buying, selling, leasing, real estate, and so on, accounted for more than 20% of GDP, compared with around 10, 11% contributed by manufacturing activities in the US economy. And the financial sector also accounts for an increasing portion of non-farm corporate profit in the US, around 10% in the decade after the war, and now 50% or more. In fact, many industrial companies in the US really, they have to rely on profit and revenue from financial transactions, selling, buying, investing in financial assets in order to supplement or to offset the operating revenue from their mainline manufacturing activities. For example, GM finance profit now accounts for more than 1/3 of total profits of GM. So without the financial activities, they will be a very poorly performing industrial company. Also, if you look at globally, the role of the US dollar is very prominent, accounting for lion's share of, as I said, FX trading in terms of currency of foreign bond, international bond issuance, and the international assets and liabilities of international banks. Many banks outside of the US are heavily depending on non-native dollar funding source as a key funding source for their global activities denominated in the US dollar. So to make the long story short, these financial conditions and activities contrast sharply with the fact that global economic growth, as measured by global GDP, has declined and decelerated steadily over time. In the decades before the 1980s, the start of financialization, global growth or global GDP averaged around 5% per year, and it decelerates steadily since then, so that right now for this decade, 2020s, the estimate is for global GDP to grow by 2.2%, according to the IMF. So basically a sharp slowdown in global economic activity, a sharp increase and appreciation of financial transactions and asset prices. And therefore, in my view, the gap is becoming unsustainable. And in fact, over the years, there are many incidences where this incompatibility between financial activities and real economic activities manifest themselves in financial crisis. We mentioned the black market crisis in 1987, but also the great financial crisis a decade back in 2008, which necessitated central banks around the world to pump huge amount of liquidity into the financial system, raising their financial assets in their balance sheet from 5 trillion before the great financial crisis among the 5 major central banks in the world to 20 trillion in 2018. And then when the COVID pandemic hit, causing market turmoil in the early part of 2020, they come in again and again, raising their balance sheet from 20 to 31 trillion dollars as of last year, more than 30% of global GDP. So basically, my thesis is that if you look at the gap, widening gap between financial sphere and activities, underlying economic activity which is slowing down, you look at the fact that the governments between fiscal policy and monetary policy have been called upon to come to the rescue of the economies time and again by deficit spending, by fiscal stimulus, by extending liquidity into the financial system via ballooning the balance sheets. Governments are really having their resources overstretched in terms of high government debt. If you look at the G7 countries, government debt is now about 127% of GDP. Again, if you look at the balance sheet of the 5 major central banks in the world, the Fed, the ECB, the Bank of Japan, and the PBOC, more than 30 trillion US dollar. In other words, they are in a very overstretched position if they are called upon when the next major financial crisis materializes to quickly, promptly, and inadequate resources to come to rescue and to stabilize the major crisis, especially since the potential for losses in asset values have skyrocketed, given the sharp increase in the value of financial assets. So I think that, in my view, it is difficult to pinpoint what specific circumstances or the timing of the next major crisis, but one is not clearly, is in my view, clearly will be on the horizon. The problem is that when that happens, governments will be in a much worse and weaker position than the great financial crisis in 2008 to really come and stabilize the market conditions. In other words, we have financial activities, economic activities being done with a very overstretched and weak financial safety net underneath. And therefore, in my view, this divergence and the uncertainty around it constitute the greatest risk to the global economy at present. And I think John Greenwood will amplify and make it more concrete based on his essay that he wrote about the conditions now similar to those that we found before the Black Monday market crash in 1987. Also, as per Anthony's request, I will say a few words on China, also from a general perspective. And of course, to be consistent with the theme of financialization, we should recognize that China also experienced huge financialization as well, even though there it happens to the banking system. So the banking system asset in China is very big, huge. It's 200% of GDP, twice the ratio in the US. And therefore, they have also a very high level of financial activities, but through state-owned banks. They have big problem. I focus only on one, which is high level of debt. Indeed, in terms of non-financial corporate debt, China has the highest, one of the highest level and ratio of debt to GDP and absolute amount of non-financial corporate debt. However, I just want to point out that they have those debt, but number one, mainly in renminbi, in the local currencies. They have the debt, but they have very high household savings ratio, which allow the domestic economy and the household sector to accommodate and to own the debt. And last but not least, they have run cumulative current account surpluses over the years, so that their net international investment position is now almost $3 trillion in the plus. All these three factors are somewhat similar to what we have seen in Japan. So that's why Japan has very high level of government debt but have been able to get through without any financial crisis. So I would say similar thing I expect for China as well, because if you look at the debt structure more closely, you will see two things. One, it is focused mainly on the corporate side in the real estate developer sector, and on the public side, on the local government and local government financing vehicle sector. Those are the two clear pockets of debt. Whereas the main manufacturing companies, most of them state-owned, in fact, have deleveraged over the past 10 years. The debt-to-equity ratio of these listed industrial companies, many of them still state-owned, have declined from 0.65% 10 years ago to around 0.55 at the moment. So that increase, yes, but they also raise their equity capital as well. Now, if you look at the two pockets of debt of China, developers and local government, you see that the Chinese government has been aware of the problem and have been taking policy measures to deal with the problem. For example, in 2021, they started to force developers to deleverage, to reduce the amount of debt by having the 3 red lines that really constrain their ability to raise funds if they don't meet the financial ratios. That started a process by pushing these developers to reduce their debt by a variety of means, and some of them have to be pushed into near bankruptcy and declare debt default. But they have done it, in my view, in a controlled way, slowing the activity, allow the market to deflate, asset price decline slowly over time. And because of doing that, they can contain and control the pace of decline to allow the sector to get back to equilibrium over time. It means over the next few more years, the whole sector will be slow, even very not being able to grow too much. And that will be a major drag on the economic growth of China, because the real estate sector accounts for between 25 to 30% of GDP. So they trade crisis for slow growth, and that is how they have dealt with the Asian financial crisis back in 1999, 2000 as well. On the government side, the total augmented government debt of China is around 93% at the last count, and that includes 21% central government debt, 29% local government bonds, and 45% of GDP accounted for by local government financing vehicles. You add them together, 93% of GDP, not low, but still much lower than the G7 average of 127% of GDP. And in my view, theoretically, the Chinese government can easily issue central government bonds and use it to replace all the local government bonds and all of the local government financing vehicles debt as well. They can keep 93% debt to GDP, changing the composition from the mixture of 3 into 1 central government bonds, and still stay below the level in many developed countries. Of course, they will not do that, but that is theoretically something they could do. And I think that the Chinese government will do some of it to some extent going forward. In other words, they have plenty of room to quell and to make sure that the local government debt will not explode into a crisis. So to make the long story short, this contributes into my assessment that the economic growth of China will be slower going forward, but financial crisis will be avoided. With that, I hand it back to you, Anthony, and then we can have a discussion later on.
Okay, thank you very much indeed. Lots of data in there. You made the position that you made the point that central banks are overstretched. Governments are not in a position to really bail out the financial sector, and there's a weak safety net. So when the next crisis does erupt, obviously the background is not going to be favorable. Unfortunately, we still do not have John Greenwood with us, who was going to explain just why he thinks a crisis is imminent. Still hoping he will show. We've made earnest efforts to contact him. But in the meantime, let me ask Jesper to make your contribution, Jesper, and if you want to comment yourself on some of these points of why a crisis could erupt. I'm not putting words in your mouth, but if you could give your view on that. And I might come back to you again later, Hung, for some thoughts on problems on the bond market and so on. But Jesper.
No, it's funny. Thank you very much. And I love the sort of big picture. Oh my God, the next crisis is near type of stuff, which is always good. We always need to be vigilant here. But I'm a little bit puzzled always by the fact that people always look at only one side of the balance sheet, which is the debt side of the balance sheet. And they don't look at the asset side of the balance sheet, because it's not your fault, it's not my fault. You can look at the global financial system, and what you actually see that for every $1 of debt taken out over the last decade, the global economy has created about $2.8 of savings. Ironically, I think that yes, obviously there is this phenomenon of financialization. But at the same time, we actually live in a world of savings surplus. And I still think that the most phenomenal paper of our generation, at least, was Ben Bernanke, talking exactly about the savings glut. There's too much savings, and at the same time also, the global economic and the global value creation system has changed fundamentally. I mean, if you and I want to build a semiconductor factory, it will cost us between $10 and $12 billion, right? For you and I to build a successful and global reach, software operating company will cost us between $10 and $15 million. So, it's a tremendous gap. Which one creates more value? I think, the reality of, mining and farming and manufacturing being the only value creator, well, that doesn't seem to ring true, for anybody who actually does work in the service sector. So I think that, obviously we do need to be vigilant, but for all intents and purposes, I am not that concerned. And in fact, would also counter the argument that, the safety nets and the ability of policymakers to act. And here in particular, I mean, the reality of the Federal Reserve, actually running with policy rates, slightly in excess of 5%, you actually do have lots of leeway, to cut interest rate and to inject liquidity, et cetera, et cetera. One case in point, by the way, in February this year, the end was near when Silicon Valley Bank, had its little hiccup, but that problem was solved within 3 days. For all intents and purposes, So I think I don't want to be overly rosy here, but I think in terms of the global overall system there, I think that the fact that the world economy has $450 trillion of wealth and the global economy is about 100 trillion in terms of GDP, well, that's very nice and well. Global GDP has grown from 30 trillion 25 years ago to 100 trillion. And for all intents and purposes, whether it's India, whether it's Indonesia, whether it's Africa, there's plenty of new growth opportunities that are going on. So I want to bring it down a little bit to sort of more specific, sort of level, sort of focusing on, maybe the next, sort of 12 to 15 months, something a little bit more tangible. And also focus a little bit, on specific realities here in Japan, because we can talk about the global economy, and it's probably best to have a good glass of wine, to do that. But honing in a little bit on what's going on here in Japan, I think is quite interesting. Sure. By the way, and it's also interesting, before we go on to Japan, it's like I've always been successful in strategic advice and in investing when you cut the noise and actually just focus on the data. And the specific data I'm talking about is capital formation, business investment expenditure, as well as, of course, foreign direct investment. If I can see, which is very good data, very available, where does Siemens, where does Hitachi, where does Hyundai, where do they invest and build new factories, new logistics centers, new facilities. And what you actually see is that, foreign direct investment, has shifted quite dramatically. As you know, China is now net negative, right? But, the growth of foreign direct investment into the United States of America is phenomenal. Right, you've got a record buildup, of U.S. construction in actually building factories, in actually building productive facilities, and for all intents and purposes, if you cut through the noise as an economist, where new factories are being built, right, that's where the potential growth rate actually goes up. So my number one message actually is that we may not like the politics of what goes on in the United States of America, but in terms of the actual bare-bone economics, when you look at capital formation, when you look at employment creation, it is actually quite extraordinary what is actually going on there. And for all intents and purposes, the potential growth rate of the United States of America, because of this tsunami of capital formation that is taking place there. I think the potential growth rate in the United States is currently being underestimated. While for the same reason, perhaps, the potential growth rate in the People's Republic of China, is still a little bit overestimated, right? But so that's sort of at the big picture, which we can sort of go back here. Specifically for Japan and specifically for the next sort of 12 to 18 months here, I think that this year, Japan had tremendous tailwinds. Number one, with obviously the currency weakening, with obviously the United States of America in particular, having a very robust, growth momentum and a lot of impetus for Japanese companies to actually invest there. And on top of that, you had at the microeconomic levels, some very interesting initiatives being taken that particularly in the world of investment, were very important. What I'm talking about here is specifically the Tokyo Stock Exchange, basically becoming an activist investor and basically threatening to shame companies if their share price stays below 1 on the price to book measure, right? So that was this year. Lots of good things coming together, and as a result of that, Japan's capital markets, for all intents and purposes, having outperformed or having performed very, very nicely. Over the next 12 to 18 months, it's the reality check. We need to see that some of these measures are actually being followed up. And specifically, we will have at the end of January, for the first time, the Tokyo Stock Exchange actually publishing its list of companies, what are you proposing? If your price to book is below 1, what are the measures? Can we appreciate these measures or, are they not sufficient? That's, I think, going to be very, very important in terms of the overall, development here. And in my personal opinion, certainly from the discussions that I've been having with CEOs and corporate leaders here in Japan, everybody's taking this very seriously. And I do think, that, for all intents and purposes, certainly for the larger companies, for the Keidanren companies, I do think that there will be positive surprises in terms of the measures, that corporate leaders are actually going to be announcing, to make their balance sheets less lazy, which is really, what this TSE initiative is all about. The second thing is, there's a lot of sort of the domestic capital formation. Japanese companies in both the industrial sector as well as the service sector, actually reinvesting, adding new capacity, putting into place more and better equipment. It's very important. People always forget, business investment expenditure is running at the highest level it has been in over 60 years. Which is quite tremendous, right? So you actually do see, Japanese companies investing in their productive capital stock. Which gets you to the next issue. It's not just investing in productive capital, but it's also investing in human capital. And what is interesting here is obviously, there's a big headline focus as every year on the Shunto wage negotiations, right? With Rengo, with the unions asking for around 5%, we'd see where that's going to end up with. But in my personal opinion, what's much more important, rather than the base up of the union negotiations, rather than the Shunto itself, what's much more important is companies beginning to change the way they compensate their employees, moving away from seniority-based compensation towards merit-based compensation, is starting to happen. NTT, which is one of the most unionized companies in Japan, from April this year has introduced pay for performance, breaking away with merit-based compensation. And that's, I think, where it gets very, very interesting, for Japan, because at the end of the day, how and where is productivity going to be generated? Productivity is going to be generated by changing the incentive structures, for Japanese workers, for Japanese employees. And so watch out in 2024 for more companies, announcing a shift away from seniority-based pay towards performance-based pay. And then last but not least, we do have, obviously the accord between the Ministry of Finance and the Bank of Japan, for all intents and purposes, being very much intact. Yes, we've got a new governor of the Bank of Japan, Governor Ueda, but for all intents and purposes, at least in the first 6-7 months of his regime, his communication with the Ministry of Finance, with the Prime Minister, has been excellent. And, from that perspective, I think that, it's very, very unlikely that the Bank of Japan is going to do anything dramatic, right? And it's interesting to see that, unlike what we've seen in Europe, unlike what we've seen in the United States over the last year and a half, where generally, inflation was a problem, and the Federal Reserve, the ECB, did have to step on the brakes in order to destroy demand, right? Here in Japan, there's no need whatsoever to destroy demand. Yes, there is some imported inflation, but for all intents and purposes, the evidence of demand pull inflation is still very, very sparse in between. So from that perspective, there's no fire that the Bank of Japan needs to fight. And, from that perspective, I certainly expect that the Bank of Japan is going to be very, very, very measured in terms of normalizing its interest rate policy. I do expect that short-term interest rates are going to go up. I do expect that by Christmas 2024, Bank of Japan policy rates are going to be at 0.3 to 0.5%. Right now, they're basically zero. Right? So a very gradual, but not the type of stepping on the brake that we saw in the United States or in Europe, over the last 2 years. So for all intents and purposes, I think that the coordination, between the Ministry of Finance, between the Prime Minister's office, and the Bank of Japan, I think, is going to be coming through. There's one thing people always ask, but what about the yen? Right? And it's interesting because, I was just at the Ministry of Finance yesterday, and, it used to be everybody had a strong opinion about where the yen should be, right? Now, actually, the yen is an outcome of the policy. Is it causing some pinch here in terms of imported inflation? There's no question that it does. But is this a big problem, right? I mean, is Prime Minister Kishida's popularity going down because of imported inflation and a weaker yen? I don't think so, right? There are many other issues, right, that are actually going on there. So I think for all intents and purposes, the yen, or the Bank of Japan changing policy to defend the yen is the last thing that is going to be happening, right? So I think that the exchange rate is going to be, the adjustment mechanism, rather than the target, for any of the policy action coming through there. So that's sort of a couple of things that I did want to say. I wanted to highlight, sort of two issues that are of concern, because we got to be cognizant of some of the things that actually have changed. And the most important thing that has changed in the Japanese economy is the fact that Japanese exports are way underperforming, given the strengths that we have in the global economy, as well as, of course, the weakness of the currency. The elasticity of Japan's exports into global growth has gone down tremendously. And it's interesting when you look at some of the details, it's obviously the weakness to the People's Republic of China that stands out. And you can be lazy and say, oh, that's because Mr. Xi Jinping doesn't know what he's doing, the Chinese economy is falling into deflation, blah, blah, blah. Well, that's actually nonsense. What is actually happening is that you're starting to see significant substitution. That the Japanese machinery companies, the Japanese machine tool companies, even global leaders like Fanuc, the robotics companies, orders from the People's Republic of China are down 50, 60%, right, this year. But this is not because the Chinese economy is weak. This is because China now has companies, right, that are domestic companies, that are Chinese companies, that make perfectly fine robots that actually replace, the capital goods expertise and de facto oligopoly or monopoly that a lot of Japanese companies have. I mean, remember about 10 years, 15 years ago, we had the replacement of the Japanese Shinkansen with the Chinese Shinkansen. The same is now happening at the high end of the machine tool and machinery industry. And that's, of course, sort of a real issue, right, that the Chinese have caught up in terms of technology as well as in terms of commercialization, capital goods, and that's, of course, a negative, for Japan's export competitiveness. The second thing, of course, which goes in line with that, which is the fact that the rules in the United States have changed. Local content rules, if you are building a factory in the United States of America, after the Inflation Reduction Act and the CHIP Act, right, your local contents requirement have gone up very significantly, which again means that Japan's exports of machinery and machine tools, are going to be under downward pressure. As you probably know, it used to be in the 2010 to 2020 period, about 62% of all the equipment that goes into an American-built factory is made by Japanese companies. Right? And so if there is going to be some substitution from that perspective, then again, exports from Japan, are definitely going to be a weak spot, that needs to be monitored going forward, irrespective, unfortunately, of the level of the currency or of what goes on in the global economy. So that's sort of at a very, very high level, sort of the couple of things that I wanted to highlight, and maybe we can open it up for discussion. Thank you.
Thanks, Jesper, very much. Okay, before we do, Hung, I'd like to come back to you, if I may. Jesper's made the point about capital formation still being very strong in the United States and elsewhere, and that's an interesting point. But we, unfortunately, and again, my apologies, we still don't have John Greenwood with us. But if I can just attempt to very quickly summarize what he's saying. John Greenwood and a colleague of his published a paper very recently saying that we were heading for another Black Monday in stock markets. The way they put it was that the global economy and stock markets are running on fumes. What they meant by that was that there's no longer enough, if you like, finance easy money available as fuel, so we're just running on fumes. The tank is empty. So, Hung, what I'd like to ask you is, do you agree with this? I mean, again, Greenwood's basic point was that after a decade of very low interest rates and very easy money, we're now going to a different situation of rising interest rates and tighter money, quantitative tightening and so on. And he says we've not begun to see the effects of this yet, but we're going to see it in a very serious way quite soon. As the availability of money, and especially money on terms that people can afford to pay, is going to become much tighter. So, Hung, first, do you agree with this basic thesis that despite what you said about a tremendous surplus of financial activity, money is tightening, and this is going to have a severe effect on stock markets and presumed on bond markets too? Do you agree with that basic thesis and that it could cause a crisis? And secondly, what is your sense of, you are in Washington, you are in regular contact with New York, obviously, markets. How much fear, if you like, is there in markets that we could be approaching another Black Monday? So could you make a couple of comments on that, please?
Well, two things. I think rising and high interest rate for a long period of time clearly has contributed to tightening of financial conditions in the US and elsewhere. However, the impact of that is bifurcated along the bigger, stronger players and the weaker players. Mm-hmm. If you look at banking institutions, the 5 major banks in the US are doing very well. They are very highly capitalized. They have had very good profits, and they also enjoy deposit inflow from the weaker members of the banking system. So for the bigger banks in the US, higher interest rate will serve them well, and they will benefit from that. However, regional banks and community banks really have suffered. First by their deposits being pulled away to a larger bank for safety and to money market funds for yield. And they have to compete to retain the deposits, raising their cost of funding. So yes, for weaker banks, they will have problem. They already have tightened their lending standard and reduced lending. And therefore, the sectors that depend on local and regional banks probably will be a challenge for funding going forward. The same can be said of the non-financial corporate sector as well. If you look at the major big companies, I think they are in a pretty comfortable financial situation. They can issue bonds, and they don't really need to go to the banks for financing, and they should be able to cope with higher interest rate. Again, the weaker member of the corporate sector clearly have a problem. They already cope with higher level of interest payment on their income statement. The interest ratio coverage has been declining, so they have less earning to cover their interest expenditure, and therefore with higher interest rate, they will be under pressure. So if you look at the total picture, the weaker members of the corporate sector, of the household sector, of the banking sector will suffer. Will that constitute the condition for a major financial crisis? Probably not, but that is where I would pay my attention to. Your second question about the conditions that can give rise to Black Monday market crash. Two things. Going into the Black Monday market crash, the equity markets have rallied almost continuously in the years before that. Price earning ratio valuation was very high going into the market crash, and that probably create the condition for a crash. Crash means correction in overvalued and unsupported valuation of asset prices. This time around, we have had a market correction going on for most of last year, 2022, some correction this year, but by and large, we are still below the peak reached at the end of 2021. P ratio still higher than the long-term averages, but not by that much. So I would say the condition is less imbalanced to the extent of a major crash is becoming, reasonable to expect. So I think corrections, yes, but nothing comparable to the Black Monday crash in 1987.
Yeah, what about turbulence in the bond market? There has been considerable turbulence in bond markets. How concerned are you that indicates an underlying serious problem?
Yes, there has been occasional problem in the bond markets, particularly caused by the need for players to raise funds, money market funds to meet redemption, or the investors that need to liquidate their holdings like the regional banks and so on. So in a way, the Fed has basically tried to deal with that situation by having more or less permanent facility to become buyers of last resort in the treasury market through the reverse repo facility, whose customers are largely money market funds. So that really provide a very robust safety valve for this kind of treasury market fluctuations that we saw in September 2019 and in March 2020. So the Fed now is basically a lender of last resort to banks through the discount window and through the financial facility that they instituted after the March 2023 regional bank crisis, where banks can turn in their held to maturity treasury securities at par for 1 year duration. So that really helped a lot in terms of providing backup liquidity against treasury to those institutions. And again, the reverse repo facility with money market funds will address the need for these money market funds to move in and out treasuries in a short time period, causing turmoil. So I think that these technical features goes a long way in helping to stabilize market. But again, at the cost of really stretching the involvement of the Fed in the private sector allocation and pricing of credit. It's not really private sector open market anymore. It is really between the Fed becoming more and more a key market participant in determining the demand, supply, and pricing of short-term credit. So I think that is the danger in the long term, in the sense that we really have an economy becoming depending on public institutions of the central banks, on the fiscal policy of the government. And I think that we have to keep in mind that, yes, global economy now is $1 trillion, but financial asset is 4 times that much and growing much quicker than the global economy. Basically, financial assets mean discounting the future claims from the underlying assets. And the global GDP, the economic activities, is the thing that create the value added with which to service the claim of asset holders. If you have more and more claims, but you have less and less productivity and production to create value added to service the claims, at some point you have a crisis. You have the gap that cannot be reconciled. And I agree that activities all over the world is shifting from manufacturing to services, but that is why we have the overall slowing down in growth from 5% after the war to 2% now.
Yeah, but I've got record unemployment everywhere.
Okay. Do you want to make a quick comment on?
No,
Okay.
I mean, all of these points are obviously very, very valid, and like I said, there's plenty of reasons to be vigilant. But I mean, it's my God, interest rates go up, and then yes, the weaker players get sorted out, and the governments everywhere in the world are trying to wean off some of the COVID support measures, so to let zombie companies actually go by, and in some cases that goes faster, in some cases that goes slower. But if you look at resource utilization, I mean, you've got record low unemployment rates everywhere, right? I mean, what GDP does, whatever GDP does. I mean, it's a weird construct for all intents and purposes. But in terms of the actual, utilization of resources, it's tremendous. And, all the latest data, over the last 2 years basically suggests that even the gap between the lower wage earners, the lower income earners, and the middle class and the high income earners, even that gap, is starting to narrow because, plumbers and restaurant workers, are seeing wage increases of, 12, 13, 14, 15%. So it's again, we need to be vigilant here. The other big counter argument, I mean, I think would make is like, you look at a global financial crisis and the risk of this, there always is, right? But typically those things happen when some government, actually oversteps on the brakes too aggressively. So when the discount value, specifically when you actually increase interest rates by too much, and for all intents and purposes, whether it's the ECB, whether it's the Federal Reserve, I mean, they're pretty savvy at this particular point in time. And then as to the private sector, everywhere you look, whether it's the household sector, whether it's the institutional allocators, or whether it is corporations, you've got record amounts of cash holdings, right? I mean, Warren Buffett, just to use one highlight example, right, has never had as much cash in his portfolio as he has right now. And all my friends in the money world, right, they're waiting, yes, they're waiting for an adjustment in US real estate prices, for example, right? But, you know, the moment, you know, you actually start to see New York skyscrapers or, you know, Los Angeles skyscrapers come on the market at 60 cents on the dollar, a lot of people will buy. It's a nice, I mean, you know, there is a financialization, obviously there is, you know, but precisely because of the financialization, we actually do have a great cushion.
Okay. All right, well, I have a question, but before I do, let me ask if anyone in the room has a question first. No questions? Yes, Rick, yes, please. Can you go to the microphone and just say who you are and put your question, please?
Yes. Is this on?
Is that Mike Dijkvizka?
Perfect.
This is very interesting. There's a lot that more comments than questions. Is that acceptable?
Yeah. Yes, a comment if you wish. It's an informed comment.
Rick Dyke with Japan Industrial Partners, a Japan-based private equity fund. In speaking both about what Hung Tran is saying as well as what Jesper is saying, I'm focused on Japan, so I can't really comment, except what we're seeing in Japan, when we talk about the Tokyo Stock Exchange now making public the companies that have price-book ratio below 1, a price-book ratio below 1 is a sign of productivity problems, either the efficiency of using cash or whatever that affects that. And what we see as a private equity fund is that Japan is doing amazing things to address its fundamental efficiency and productivity problem. For example, Hitachi has now divested nearly all of their publicly traded subsidiaries. And that cluster of public traded subsidiaries was basically a remnant of a planned economy when Hitachi served NTT, Japan National Railways, the 9 power companies and so forth. That planned economy is changing, and one would hope it's changing to a market economy. We still have to see. But so we, for example, took Hitachi Metals, we took Hitachi Construction, we took Hitachi Kokusai. And our private equity fund is 20 years old. The last 10 years, we've decided the thing to do is just to focus on productivity. Not the top line, but getting everything below the top line productive. And then, during the span of time that we have a company, then find a home for the company that will address both the top line and maintain an effective bottom line. And that has become very effective. And I think that's the right thing to do for private equity. This is happening again and again in Japan. A couple of interesting things. These huge transformations are happening in Japan with a minimum of shareholder lawsuits, of major, but they are happening because of the activist shareholders, which of course are in Japan not called activist shareholders, but monoyu kabunushi. And it's the right of kabunushi to have a voice. And Japan is not trying to stop that. So I think in Japan, we do see major addressing of the productivity problem, and we'll see where this goes over the next year. I could only talk about Japan.
Okay. So it's really a comment rather than a question then, really.
A comment rather than a question.
Okay. 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 I'm sorry to labour this point, but Hung, I'd like to just come back to you on one point, and that is, I still think we haven't completely addressed John Greenwood's points. Not that it's my job to do that, but many monetary policy acts with a lagged effect. I can't remember who said that, but anyway, whoever it was, it's well-known saying. My point being that after, as I said before, more than a decade of very low interest rates, very easy money, we're now moving into a different situation, and it will take some time, I presume, for the impact of that to show through. In other words, okay, inflation may be slowing down now, interest rates may have peaked, but that doesn't mean to say that interest rates are going to return to zero anytime soon, as the Americans say. So have we really felt the pain yet from tighter money, higher interest rates, or is this still to come in the shape of financial system problems, corporate bankruptcies possibly? Hung, if you could just come back to this again and say a bit more about this. Have we really felt the pain yet of tighter money and higher interest rates?
Yes, we in the US have felt the pain, but there's more to come, because the lag between monetary policy action and subsequent impact on growth and activities is about 6 quarters, up to 6 quarters. So the tightening that we saw at the late 2021, early part of 2022 will come through fully next year. So next year, I and many other analysts expect slower GDP growth for the US. One, because of the lag effect of monetary tightening over the past year and a half. And second, the full 5 trillion plus fiscal stimulus that the US government gave to the economy during the COVID years will have fully spent and exhausted by then, particularly the extra 2.5 trillion excess savings in terms of household receiving checks from the US government. They will have spent all of that by the end of this year, so that they are back to the usual household financial circumstances. We already see that in the saving ratio of the household sector in the US coming down to the 3% area from the 20+% in 2020, 2021. So I think that the tightening that we will see fully playing their role next year is both from the lag effect of monetary policy tightening and the delta, the change in the impulse from policy, fiscal policy in terms of the previous stimulus will have been spent.
So will that manifest itself in corporate distress, or will it manifest
It will
itself?
basically manifest itself in slower growth, slower consumer spending, and contrary to what Jesper said, capital formation after the gyration during COVID years and after COVID years is back to where it was before COVID, which is low, not very high. So I think that basically both capital investment, capital expenditure, and household saving spending will be slower next year than this year. Now, will that be enough to occasion financial crisis at this point? No, one can argue that way, but if you look at, as I said, the valuation of the equity markets, it doesn't seem to be such out of place that a correction, a big correction is likely.
A big correction, did you say, sorry?
I said that the overvaluation is not so stretched that one can think of a big correction.
Okay.
So I mean, smaller correction, yes, big correction, unlikely in my view, just because of the relative valuation before such a correction. You have less overvaluation, you have smaller correction.
Okay. Again, I find myself in a very difficult position because I'm not John Greenwood, and I'm sure he would be arguing much more strongly than I am.
You can put his say on the for the participant to download and read.
You have a question? Yes, please come to the microphone and.
Hi, my name's Peter. I write for Asia Times. I usually write about Myanmar, but I try to follow business and economics. And my question is: so this threat from China of the higher value machine equipment and other products as well. How big of a threat is that to Japan's economy, and what is Japan doing about it? You said that Japanese companies are investing in capital and so forth. Is that a reaction to it? And can Japan sort of shift to other sectors? Can they increase services, or can Japan do anything?
And this is the key issue. I think, that, for all intents and purposes, the source of marginal growth that over the last 20 years you did get from the People's Republic of China. Because number one, you had better technology, right? And number two, China was on a super high growth path, right? So that was like a windfall that, of course, the Japanese, as well as everybody else, exploited and benefited from tremendously. You can show exports and production in the People's Republic of China basically boosted Japan's GDP by about 0.6, 0.7 percentage points, right? Every year over the last 20 years, right? And that's going. And so the question is, okay, what do you do? So is Indonesia, is India, are some of the other ASEAN Indo-Pacific countries going to take up the slack that, the combination of lower growth in the People's Republic of China plus a more competitive domestic industrial sector. So that's what every Japanese company is very, very focused on. And to the point that was made earlier, right? The domestic restructuring, right? Raising the efficiency of capital, of labor, right? This whole, what people call productivity, right? Which is the balance sheet, which is your human capital, which is your suppliers and vendors, just lowering those break-even points that you can, even with lower growth, even with more fierce competition from the People's Republic of China, and quite frankly, the Koreans as well, right? That you can still be profitable. That's the big challenge. And that's why corporate Japan right now is in this exciting, time, because you've got this generational change, right? I no longer need to fight the fires of asset deflation and yen appreciation. I've now got some tailwinds from the currency and from domestic asset prices increasing, but I am fully aware of the fact, right, that, global competition is going to get tougher. And as a result of that, I need to explore new markets. So it's not a coincidence that, for example, we don't look at it very much in the private sector yet, right? But the Japanese government over the last 12, 15 months has become very focused on Africa, right? And Africa, for all intents and purposes, I'm not an expert whatsoever, but the population dynamics, the growth dynamics is obviously a very, very strong one. And as you know, the whole, under Prime Minister Kishida over the last 12 months, the whole way foreign aid is allocated to Africa has changed with a much greater emphasis now on public-private partnerships, exactly for the reason that you point out, right? That I do need to find new markets, I do need to find new high-growth markets, and that's where now the Japanese government, in partnership and with greater incentives for the private sector, is actually starting to shift gears, right? So watch out for Japan-India, Japan-Indonesia, and Japan-Africa as sort of the new sources or potential sources for growth.
Okay. Hung, I just want to come back to you briefly, if I may. That is, you repeatedly made this point about the financial sector becoming so big in relation to the manufacturing sector and presumably in relation to the service sector too. But when should we start worrying about this, and why should we start worrying about it? Could it lead to inflation? The fact that you have a very large financial sector and, relative to other parts of the economy, why should we worry about that?
Well, as I said, as a generic answer to your question, financial crisis is the moment where people realize that the claims embodied in the value of their financial assets that they hold will probably not be fully served because of the underlying economic activities of the companies issuing the debt or issuing the equities, or of the economy growth, potential growth rate. If that is too low, then the claim that you embody in your present valuation of your assets is out of line with the underlying activities. When that moment comes, sometimes suddenly people wake up and say, oh my God, what I claim going forward in 20 years probably will not be sufficient, will not be there to really justify my valuation today. That's where you have.
But what could trigger that? What kind of event could trigger a crisis centered around that?
Look back at the great financial crisis. What triggered it? the single event that triggered the whole thing is just one small money market fund in Paris stopped redemption of their fund. And that suddenly changed everyone thinking about, how valid is their value of the assets they have, how liquid is it, can they get their money back? And the rush to get out in time before the next person is what caused and initiate a crisis. Going forward, what could that moment be? I don't know. But I just look at the underlying discrepancy and divergence between the financial activities and the underlying economic growth to say that that gap cannot be sustained, period. When it will not be sustained, I don't know, but it will not be sustained.
Okay.
And we can come back to this question a year from now and I can say, I told you so.
All right, we'll invite you back in a year's time. Okay, any more questions? Yes, Kurt.
My name is Kurt Sieber. I'm Swiss, and I'm, quite a lot actually working with Switzerland, and this comes up with the sovereign, the debts of the governments in Japan and the United States. Those are the two major ones who are running totally, that know themselves anymore where they are. I'd like to say that the last figure I have from Switzerland is that the sovereign debts of the government is about 40% of the annual. What percentage was I? The annual size of the economy.
Yeah.
Another thing directly, which I recently read about Japan, which I was really shocked, was that Toshiba has worked out 54 trillion yens of debts, and for this reason also it had to be taken off the stock market. That was for the moment, yes. Thank you.
Okay, all right. I don't think perhaps we're coming up close on finishing time, but China. Hung, you've talked about the position of the banks and so on, local authorities in financing and so on, but we've just had this summit meeting, if that's the correct term, between President Biden and Xi Jinping. Doesn't seem to have achieved anything really startling. Obviously a very serious problem of, decoupling, reshoring and so on, world splitting into two basic economic blocks and so on. It hasn't really apparently had a very big impact yet, but assuming that relations between China and the United States don't improve dramatically over the next year or whatever, how much impact is this going to have on global trade, do you think, and on, generally on economic activity? I mean, supply chains, we presumably haven't seen the impact yet fully worked out, but it's continuing to work out. So, assuming that China and the US don't become bosom friends within the next few months, how much impact on the global economy and indeed on the financial system could this bifurcation have? Hung, perhaps you could have a crack at that first.
Yes, I think that irrespective of the latest summit between Xi Jinping and Biden, US and China will remain geopolitical competitors and rivals for a long time to come. And therefore, the fragmentation of the economy, global economy, caused by the global geopolitical competition, which has already happened, will deepen and will accelerate going forward. The IMF already done a lot of research into this, and they can clearly describe the fragmentation in different spheres, from trade to FDI flow to even portfolio flow and banking flow among countries more friendly with the US and country more friendly with China, and that has happened. And they estimate roughly the loss to global GDP out of the fragmentation, causing rising cost of doing business, causing loss of efficiency, and so on and so forth, 7 percentage point of global GDP going forward. And my view is that we can easily reach that level of loss and even more if the fragmentation deepens into more sphere. Basically, both sides going forward cannot avoid not de-risking from each other. US de-risking at the moment with the small yard, high fence approach for a small, pretty well-defined area of high-tech computer chips and so on and so forth, but very stringent measures to contain China. And China, of course, de-risk from the US, particularly potential sanctions from the US, by trying to trade more and more with other countries, so-called global South country. And they, in the recent year, have already achieved that goal. By now, they trade much more with global South country than with the US, Japan, and Europe combined. And the growth rate favoring their trade increases with the global South countries is much larger than the growth rate they have with the advanced economies. So because of that, we clearly see the bifurcation, the fragmentation will deepen, and that will be having a major implication for the potential growth of the global economy going forward. I mentioned 2.2% estimate for this decade. We may see a revision downward a few years from now to 2% or less. And that will have major implication for many countries. And again, particularly for the yet to be developed countries, the low income countries, they will really be the one to suffer the most from this global competition.
Okay. Do you wish to make a...
It's actually interesting. I actually think that the biggest loser in all of this is Europe. And actually, there's a lot of talk about de-dollarization, which you kind of have to take a microscope to see that the share of the dollar is actually falling, but the share of the euro is collapsing. Which is very, very interesting. And I think that, we can talk about the geostrategic, this, that, or the other. I actually completely disagree. I think that the meeting that we had yesterday is very, very important, that we do actually have communication. There is also a reopening of trade channels. I mean, we see how all of this works. But I certainly sleep more comfortably now that I know that the military between the United States and China are actually talking again to each other, which, for certainly being 250 miles from Taiwan, or no, not 200, how much like 1,000 miles or something like that from Taiwan, makes me sleep, much, much better. But I do think that here in Asia Pacific, whether it's Japan, whether it's China, whether it's Indonesia, whether it's India, you do actually have very pragmatic policymakers, and you do have a corporate sector that is actually very, very focused on getting things done, on doing business. And I'm very worried that the European economies, right, are going to be falling further and further behind, right, in this race. And of course, it's complicated by the fact that you do have, unfortunately, this war of aggression that is going on between Russia and the Ukraine, which obviously also is going to divert resources and raise energy prices, et cetera, et cetera. Let me give you one example, specifically my home country, Germany. You talk about foreign direct investment or investment spending in Germany. In Germany, it's collapsing. No German company is investing in Germany. because of high energy costs, as well as, because of, sort of, dare we say, sort of bureaucratic gridlock that actually is happening there. And that's a big worry that you actually have going forward. So in my personal opinion, I think that, since we are sort of the theme of this thing sort of morphed into sort of, my God, we're looking for the next crisis. Yeah. The next crisis will never be like the previous crisis. The next crisis will originate in Europe, not in the United States of America.
And what kind of crisis will it be?
It will be the Germans winning the World Cup. It would be a big crisis.
No, but seriously, it'll be an investment crisis or a productivity.
No, it will be a social crisis.
Social crisis.
Yep.
Interesting.
Anthony, can I say a few words?
Yes, please do. Yes, you are.
I'm pleased to say that here I agree with him. And just coming back from Germany at the conference in Munich, the talk in Germany now you hear is the industrialization of Germany, and people are taking that very seriously. Slow growth, immigration is a big problem. So the kind of combination of slow growth, no future for the young people. A lot of immigration is a very volatile mixture of things that can cause a big problem. And I think that if one has to forecast a big crisis, probably it comes from Europe. It's more likely than from the US. So here I agree with Jesper.
If you want a super statistics, it's Germany accepted, or there were basically 1.7 million people entering the country over the last 15 months or so. But what's more interesting is there's 1.6 million Germans who left.
Yeah.
Okay, I'd love to pursue this further. Sorry.
Huh?
No, you have more to say?
No, I never heard anything to say.
I'd love to pursue it further, but it's 10 o'clock here, which means we're up against time, but you've given me some thoughts for a future deep dive event. Okay, well, let me again apologize very sincerely for the lack of our third panelist. I really don't know what's happened to him. I hope that nothing serious has happened. I don't think we can actually return your money, but I hope you've had some value at least from today's discussion. So let me thank both of our panelists, Hung, you in Washington, Jesper here in Tokyo. And as I say, I hope we've had an interesting discussion despite the lack of our third panelist. Thank you very much.
Thank you.
Thank you, Juan. Thank you. When are you coming to Tokyo?
Hung, are you still there?
No.
No.
He's